Today, folks, it is Canada Day, and I thought it'd be fun to break down for you the only exposure I have to the Canadian markets in my portfolio being VDY, the ticker VDY till I motherfriggin' die, my favorite monthly paying Canadian dividend ETF that I currently hold in my tax-free savings account. I'm trying to scale this position up to being worth about $100,000 within the next year or two. Right now, I have 1,197 shares at an average buy of $46.41. The current market price is just over 52 bucks as this sucker is sitting at all-time highs. I'm up 11.26% as the Canadian markets over the last year have actually quite dramatically been outpacing the S&P 500 in the US markets, and I like having some dividend income exposure, especially in Canada. It's a great place to collect monthly income without dealing with withholding tax or other issues, and I like taking that dividend income, especially when we're in recessions, bear markets, black swan events, having a little bit of a bump to, reinvest those dividends where I think the best deals are within the market. I want to scale this to about 100K in line with a 100K position in the S&P 500 just in my TFSA, and that's kind of how I'm building this account out. But in this video specifically, I want to show you why I chose VDY over other Canadian dividend ETFs or even a broader Canadian market ETF. So if you are on a path to financial independence, if you damn well one day want to retire early, join me by hitting that subscribe button, folks, because this is a fascinating conversation to be had. So the broader Canadian market ETF, I think the best one out there is VCE. I love Vanguard. They do market cap weighted ETFs. This is probably the exact same comparable to the S&P 500's VOO, or what most people in Canada buy is VFV. So this just takes all the Canadian companies by market cap, whatever's bigger gets the bigger weighting in the ETF, and that's how they build this out. We'll break it down a little bit more in depthly, but this one also has some of the longest performance going back to 2011. So we're going to compare that to VDY and another Canadian dividend ETF being XDIV. Comparably, this is my only other real favorite dividend ETF, even over the option ETFs and all the other stuff out there, just because of the performance that we've seen since it kind of came about. This is a relatively new ETF. It's only been around since 2017. So we're primarily going to be looking at the 5-year data on these ETFs, but I do like VDY and VCE the most just because they have the longest track record. I really like how they weight the holdings in these ETFs as we break it down quite a bit farther. But if we throw in a bunch of Canadian ETFs and kind of compare it to the S&P 500, so in this ETF or in this lineup here, we've got VDY, VCE, XDIV, XEI. XEI is another favorite out there, pays a much higher yield. The reason I'm not talking about it in this video, if you go look up the ticker XEI, I think it yields over 5%. It's a BlackRock Canadian dividend ETF, but it lacks the performance in comparable. And I really just want to focus on the best performers over the history that they've been around. But right now we can see that over the last year, every Canadian stock or ETF you would have bought absolutely crushed the S&P 500, because the S&P is only just catching up to the performance now in the last year. But even VDY and VCE are up comparably 20% or more, whereas the S&P is only up 13%. But you also have to include that these Canadian dividend ETFs pay anywhere from 3 to 5% in their yields. So over the last year, you can tap on at least another 4% on average, really outpacing the S&P. But if we compare it even to VFV, because this is the Canadian version of the S&P 500, so you see the dollar conversion in the stock price. The concern here is that even if you look at the year to date, you can see that VFV is only just getting flat on the year because Canadian dollar has started to rally against the US dollar. So you kind of haven't seen much performance out of the S&P this year, but this is why I like to broadly diversify my portfolio. But again, I'm still mostly in the US markets. However, let's break this down a little bit more in depthly. Again, if we look at the comparable of these three ETFs, we can see that, again, VDY, VCE have been around substantially longer than XDIV. And I want to break these down firstly by holdings. So if we look at VCE, again, a market cap weighted ETF, it'll weight these purely based on the size of the market caps. And we can see that Royal Bank makes up 8.5%, Shopify at 6.14%, Toronto Dominion 5.8%, Enbridge 4.8%, Brookfield 4%, Bank of Montreal at 3%, we got Canadian Pacific Kansas City Railway at 3.6%, Constellation Software at 3.4%, Bank of Nova Scotia 3.1%, and Canadian Imperial at 3%. If we look at just kind of the leveling out of the sectors, you'll see that Canada is mostly made up of financials at 40.8% being the exposure. That also includes probably some of the insurer players like Manulife and Sun Life, but mostly upper weighted by the banks, with energy next in line at 17%, technology at about 11-12%. And I really don't like the Canadian technology sector. I think Shopify is a great company. I've just never been the hugest fan of it because it always seems to trade at quite a premium in value. Same with Constellation Software, even though that's been an incredibly great performing company. So if we compare it very quickly just to VDY, we can see VDY is actually much, much more concentrated, but VDY is only focusing on the Canadian dividend kings, companies with very long track records that are market cap weighted. So you're always getting like the largest market cap Canadian dividend stocks, which ironically are also the biggest companies in Canada. So you can see you have Royal Bank in here at 14%, Toronto Dominion at 9.7, which, let's be real, Toronto Dominion has been on an absolute tear as of late. You have Enbridge at 8.1, Bank of Montreal at 6.24, Bank of Nova Scotia 5.3, Canadian Imperial at 5.1, and then Canadian Natural Resources, another incredible energy player. Then here's Manulife, TC Energy, and Suncor. So you can kind of see the difference in makeup between just a broad Canadian ETF and a dividend-focused Canadian dividend ETF. And if we look at the sector exposure, again, 54% financial, so very, very concentrated. I don't think VDY is an end-all be-all solution to a portfolio just because it is so heavily concentrated. And if you put, say, $1 million into this ETF, 140,000 would just be sitting in Royal Bank. And if something materially happened to the Canadian financial sector, you could see a very devastating result in this ETF. But again, I do like it. I want exposure to the best companies, and we're going to see how that translates into the returns in a moment. So if we look at the BlackRock XDIV, this one yields a very similar dividend, actually at around 4%. And I should point out that VDY currently is paying out about just around 4%. The expense ratio is about 0.2%. And if we compare it to VCE, that only yields about 2.77% with a management fee of 0.06%. BlackRock is kind of or this BlackRock XDIV dividend ETF is kind of right in between. The yield's around 4%, so a bit higher than VDY. The expense ratio is kind of in between the two of them at about 0.1%. And if we take a look at the holdings here, we can see Toronto Dominion's about 9.6% weighting, Suncor 9.22, Sun Life 8.9, Royal Bank 8.88, Manulife 8.7, Fortis about 7.6, Power Corporation 7%, Pembina just about 7%. And then we got some pipeline companies and utilities in here at about 5%. Keep in mind, there's really hardly any holdings in this ETF. I think there's maybe about 15, 20 primary holdings that we can see if we just click over to the second page. So this ETF is hyper concentrated as well, but it's diverse in its concentration, making no more than one individual investment about 10%. VDY actually holds a lot more. I think in total in here, there's something like 60 or so individual holdings. So there's way more holdings in these top 10 as it kind of de-weights them down by the market cap, and VCE has a lot more of those holdings as well. I think it's also somewhere in the 60 or 70 range. You can download and take a look at the total holdings between these three ETFs, but that kind of gives you an idea of the different varieties that are out there, and why I like these so much really boils down to the total returns. Because as much as I like dividends, and we're going to look at the dividend growth rates on these ETFs, I really much more care about, since inception, with the dividend increases, the stock price appreciation, how much have I actually made on average every year? And we can see if we look at VCE, since inception has yielded about 9.46%. Over the last 5 years, about 15.52%. Those are great annual rates of return. They're actually like some of the best you can find out in the market today. So if we compare VCE, again, the broader Canadian market cap weighted ETF, to VDY, since inception, VDY, that's been around just as long, has yielded 10.13%, and over the last 5 years, 17.21. So again, actually over the last 5 years, we can see VDY has been doing much better, and since inception, it's basically right in line and actually doing better than the broader Canadian markets, which is crazy. So you're like, wow, a dividend-focused ETF is doing better. And the only reason I think it's doing better is because it upperweights the banks. And the banks are world-renowned here in Canada. Like Pokemon cards, I think you should collect them all. They're recognized globally as being much more stable through rockier market environments, like the 2008 financial crisis. And they pay great yields and have great dividend appreciation, which we're going to see as we dive deeper into the dividend growth rates. So you can see why I like VDY over VCE. And if we compare it to XDIV, actually XDIV has been doing slightly better here, but again, it hasn't been around quite as long. But since inception has yielded about 10.6%, and over the last 5 years, it's annualized about 7.55%. So again, over the last 5 years, VDY 7.21 and VCE about 15.2%. 0.52. So materially, if you focus on the dividend ETFs, you've done slightly better. And I think that's just because of the rockier moments we've seen through the tech companies in Canada that have got quite overvalued. So we look at the dividends. So firstly, for VCE, the 5-year growth rate has been about 9%. So materially better. And that's probably because of the smaller dividend paying companies that probably have a more, room to grow the dividend, like the railways and some of those other stocks. However, I will make a caveat here. Basically the Canadian natural resource stock has crushed it for dividend growth and has been one of the best Canadian dividend stocks. And I love how upper weighted it is in VDY. And it actually isn't in the BlackRock ETF, which kind of comes as a bit of a surprise to me for how good the performance is, because it is one of the top weightings. Your Canadian Natural Resources at 5% in VDY, and I really like that stock. I would own it on an individual basis along with Enbridge, so I do like that I get Enbridge and Canadian Natural, and that's what XDIV doesn't really have in here, which came as a bit of a shock to me in any upper weightings, because those two things are pretty pronounced for dividends and dividend growth. So yeah, if we take a look at VDY, the 5-year growth rate has been 8.78%. So again, VCE has been 9%, VDY has been 8.78%. So the growth rates are almost exactly the same over the last 5 years. If we compare that to XDIV, however, the 5-year growth rate has been 7.32%. So slightly a bit lower. So if I'm looking for income growth, VDY, I think you can start seeing why I run to it so aggressively, because the performance is almost exactly the same as a broader market Canadian ETF, pays a monthly dividend. If you compare it to XEI or many other Canadian dividend ETFs out there, you'll see the comparable performance just isn't as good. So I'm not trying to chase the dividend. And let me just pull it up real quick, because I know I keep saying XEI, but this is what I'm kind of comparing it to. This one's actually having a longer track record than XDIV. But again, if we look at the comparables just briefly, we can see that since inception, it's been about 7.48%, and over the 5 years, 15.94%. So it's not nearly as in line with the performance of VDY, but a lot of people will run to this because the dividend yield's 5.44%, and this one does pay monthly as well. I think this is a good ETF for those looking for better diversification, because no one stock makes up more than 5%. But again, diversification usually leads to less performance and growth. So concentration, as somebody that is 33 years old, is something that I want, because I understand that the more concentrated a portfolio is and the stocks, the better performance you're likely to get. There's going to be some more volatility that comes with that, but XEI might be a stock somebody might want more in retirement, but even still, I'm always going to be a total return oriented investor. And I hope you can see through what I've been showing you here why I've chosen to make VDY the primary core holding to my Canadian exposure. But do keep in mind, as I move toward wealth preservation and the individual stocks I hold start to yield results and I start pulling gains off of those gains will likely start getting more allocated toward a global market ETF. Because again, as I age, as the portfolio scales, I do want to continue diversifying, and I know that's going to weaken results. But again, if you get into an over $1 million portfolio, I think preserving that and looking for things that can offer an annualized return of anywhere from, I'm going to say, somewhere between 8 to 12% is what I want to be in line with. And I'm always going to run to the Canadian ETF XEQT. And just to give you an idea of why this is also a great global market ETF that gives you the US and Canadian market exposure, because it's primarily upper weighted US and Canadian stocks. But if we look at the return since inception is 12%. So this ETF might even be more prevalent to own over perhaps even these Canadian dividend ETFs, because it's kind of an all-encompassed ETF, yields around 2%. The expense ratio is right in line with what I'm used to with VDY. But again, if you look at the market exposure, you're 43% US and 25% Canadian, and then getting that global market exposure. Whereas I'm kind of hand selecting a little bit more concentration to the US right now, little less exposure to Canada, but over time I do want this global exposure. It's always a good idea to just, if you're lazy, you want to make it easy, this is probably the best ETF, in my opinion, that you can run to for an all-in-one encompassed global exposed ETF. But these are just my thoughts today, as it is Canada Day. I'd love to know what you're doing. Hopefully having a great time and taking it easy. But let me know your thoughts in that comment section below. Stay cool, stay awesome. And as always, I look forward to catching you in the next one.